Welcome to the deep dive. For years, whenever you heard the word blockchain, it was almost always tied to Bitcoin volatility, right? Or maybe high-priced JPEGs.
Right, or those initial coin offerings.
Yeah,
A lot of speculative froth.
exactly. But if you look past all that, what you find is a foundational technology, one that's really designed to solve one of society's oldest problems. How do you establish trust between strangers?
That is the absolute core of it, and that's why we're unpacking blockchain beyond cryptocurrency, because the applications are just so vast.
Okay, so what makes it work?
It's a combination of three specific features. First, you have transparency, meaning the record is visible to all the authorized participants.
So no hidden books?
None. Second is immutability. Once data's on there, it's basically tamper-proof. You can't retroactively change history.
Super.
Decentralization. There's no single point of control, which, eliminates that single weakest link, the central authority.
So our mission for this deep dive is to see how those three things, transparency, immutability, and decentralization, actually transform real-world operations. We've pulled from a whole stack of sources covering 5 major areas.
We're talking logistics, governance, medical records, digital identity.
Yeah, and we're really focusing on the huge shifts happening in how we manage value, identity, and ownership. So let's jump right in with the commercial world. Supply chains.
The traditional supply chain is, well, it's a logistical nightmare. It's built on all this siloed data.
You mean every company has its own separate ledger?
Precisely. You have manufacturers, shippers, customs agents, distributors, retailers.
And none of their systems talk to each other.
Not at all. And that lack of shared visibility makes it incredibly difficult to verify if something is authentic. It just leaves these massive gaps where counterfeiting and fraud can thrive.
And the cost of that must be just staggering. I mean, if you can't trust where a product came from, consumer confidence just plummets.
It does. And companies spend fortunes trying to track down the bad actors. So putting this on a blockchain, what does that actually do? It creates a single, shared, unchangeable ledger.
Okay, walk me through an example.
Sure. Imagine a container of medicine. When it leaves the factory, it gets a unique digital fingerprint.
Okay.
And every single time that container changes hands, that transaction is recorded on the chain. And because the record is immutable, you have this permanent, verifiable history.
So you can see its entire journey.
The entire journey. It's impossible for someone to just insert a fake record saying, the container was stored at the wrong temperature or it was diverted to some black market route.
So we're moving from relying on, paper trails and good faith.
To relying on math and cryptography. And this isn't theoretical. It's happening right now.
Right. The sources pointed to that huge joint venture between IBM and Maersk.
Absolutely. They are using this to track millions of shipping containers all over the globe. The benefit isn't just knowing where the container is.
It's knowing that the record is true.
It's knowing with cryptographic certainty that all the recorded events like customs clearance, temperature logs, the transfer of liability, all of it is accurate and hasn't been messed with after the fact.
Securing physical goods is one thing, but then you have the agreements that govern them. And this brings us right to smart contracts.
Yeah, this is where blockchain really starts to target that financial friction, that need for a middleman.
You mean with legal agreements? Pretty much all of them need a trusted third party, right? A lawyer, a bank, a notary.
And that adds cost, and it adds time, and it adds potential for disputes.
It's so inefficient. If I sell you a house, we're looking at weeks of escrow, title searches, lawyers going back and forth on every little detail.
Smart contracts are designed to eliminate that. They're essentially just self-executing programs that live on a decentralized network, like Ethereum.
So it's code.
It's just code. And when that code detects that some preset conditions have been met, for instance, if the buyer deposits $100,000 into the contract,
then automatically transfer the property title.
Instantly, the action just triggers. And that's what we call trustless execution.
That phrase, trustless execution, I think it trips people up. It doesn't mean you don't need trust.
Not at all. It means your trust shifts.
Yeah.
You start relying on the mathematics of the code instead of the fallible human authority of a lawyer or a bank.
Your faith is in cryptographic certainty, not an institution.
Exactly. And the results are pretty dramatic. For things like real estate or insurance claims, transaction times go from weeks or days down to hours, maybe even minutes.
Which would massively cut down on commissions and operational costs.
It just automates the transfer of value. That's a really significant economic shift.
Okay, moving from business, let's pivot to areas that rely almost entirely on public confidence. Governance, personal data. How do we apply that same idea of immutability to democracy?
By securing elections. The big problem with traditional voting is that it's just so prone to, human error to tampering to opaque processes.
All the things that fuel distrust in the results.
Right. So the blockchain solution here is really about using that immutability to restore public faith. Every legitimate vote becomes a permanent, cryptographic entry on the ledger.
So officials could audit the count instantly.
Instantly. And crucially, citizens could be given tools to securely track their own ballot without revealing how they voted.
Which is a huge increase in transparency without giving up secrecy. And again, this isn't just a theory. Estonia is way down this road already.
That's right. They run a big part of their e-voting system using blockchain. This lets citizens actually verify their choices after casting their ballots.
A level of transparency that's just, I mean, it's impossible with paper or any kind of centralized electronic system.
It really transforms the security of the whole political process.
So let's apply that same model to maybe the most sensitive data we have, our healthcare records.
The current systems are a disaster. They're constantly failing us. You have massive data breaches exposing millions of patient files.
And then just the slow sharing of records, which can be dangerous in an emergency.
This is a classic case where a decentralized architecture improves security. Blockchain can encrypt patient records, and using some very advanced key management, it allows only authorized parties, your doctor, a hospital, to access specific parts of your history.
There are systems like MedRec looking into this right now.
They are, and when you mention key management, that's really the technical core of the security.
So how should someone who's not a cryptography expert think about this? How does it work?
Okay, think of it like a safety deposit box.
Yeah.
Your patient record is the vault. Your private key is the only key in the world that can open it.
Okay, that makes sense.
Now, when you visit a new doctor, you don't give them the whole vault. You just grant them a temporary, very specific access code.
And that code might only work for certain documents inside.
Exactly. Maybe it only lets them see your allergy list, but not your psychiatric history. And the blockchain acts as this undeniable, auditable record of who was granted access, when, and for what purpose.
That security framework giving control back to the user, that seems like the perfect lead-in to this massive shift in digital identity, self-sovereign identity, or SSI.
The current centralized model is just a ticking time bomb. You have one company or one government database holding all your proof of identity.
Your date of birth, address, social security number.
Everything. And that makes them these massive, juicy targets for hackers. When they fail, millions of people are exposed.
And SSI flips that model, gives the control back to the individual. You manage your own identity securely. But how can I prove I'm me if no central authority is holding the data?
This is where the SSI trust triangle comes in. It defines three key roles. You have the holder, that's you, the user.
Okay.
Then the issuer, which is the entity validating a claim, like a government issuing a passport or a university issuing a diploma.
And the third?
The verifier. That's the service that needs proof, like an airline or a bank.
So let's walk through it. How does the holder me prove my age to a verifier without having to ask the issuer, the government, every single time?
It starts with you, the holder, generating a public and a private key pair. You keep that private key totally secure.
Got it.
The issuer, the government, validates your identity and then attests that your public key belongs to you. It posts a verifiable credential about that onto the distributed ledger.
So now there's a public record linking my public key to me, vouched for by the government.
Correct. So now, when you need to prove your age to an airline, you just sign a claim, a very specific, minimal piece of data using your private key.
And here's the magic, right? The verifier, the airline doesn't need to call the government.
Exactly. The verifier just checks your signed claim against the public key that's already on that immutable ledger.
And since only my private key could have created that signature.
The verifier knows the claim is authentic. The issuer is completely cut out of the verification loop. That's what achieves true decentralization and gets rid of that massive centralized vulnerability.
It's a fascinating application. And companies like Microsoft are already building this with their ION solution, running on the Bitcoin network. But for SSI to really take off, it has to meet some pretty strict requirements.
It really does. We usually break them down into non-functional and functional requirements, NFRs and FRs.
Okay, so what are the NFRs?
You need provability. Can the claim be proven? Portability. Can you take your digital ID anywhere? Pseudonymity. Can you transact without revealing your full identity?
And what's the last one?
Critically, minimization. That means sending only the absolute least amount of data required. If a bar needs to know if you're over 21, they shouldn't get to see your home address or your hair color.
Just a yes or no. And what about the functional side? What does the system actually have to do?
Those are the FRs. The system has to allow for issuer discovery. So, finding the right authority, connection creation securely linking the parties, credential creation, that's the issuer digitally signing the claim.
And finally, the verification itself.
Right. Verification with credentials, the verifier checking the proof. All those pieces have to work together perfectly to make SSI a reality.
That level of user control over identity really sets the stage for our next topic, which is redefining value and ownership itself through tokenization.
Tokenization of illiquid assets is, I think, poised to fundamentally disrupt finance.
Illiquid assets, you mean like real estate, fine art, diamonds?
Exactly. Assets that have incredibly high transaction costs and are hard to divide. If you sell a house, agent commissions can be up to 6%. The whole process takes months.
That friction just locks up capital. If I own a Picasso, I can't just get a little bit of cash from it without selling the whole thing.
Tokenization solves this. It lets owners fractionalize that asset into digital tokens. These tokens can then be traded globally, 247 in tiny amounts on a standardized platform.
And that standardization means you don't need a local real estate lawyer or a specialized art broker to trade a piece of it.
You don't, and the sources pointed to a great early example of this, the Marlowe Street Detroit project from back in 2019.
What happened there?
It's a perfect illustration. A single-family home was tokenized into 1,000 fractional tokens.
Okay.
And the holder of those tokens received a proportionate share of the cash flow from rental income paid directly to them in stablecoins like DAI.
That's transformative. It turns property ownership into a liquid, globally tradable investment product.
And it democratizes access to these high-value asset classes that were previously out of reach for most people.
That same principle of an immutable record is also being used for intellectual property. I saw the World Intellectual Property Organization, WIPO, has been researching this heavily.
Yeah, their research highlights a ton of uses. You can protect IP rights by creating an undeniable timestamp of when something was created.
You can document provenance for luxury goods.
Right, and aid in anti-counterfeiting for everything from sportswear to pharmaceuticals. And the legal system is starting to catch on.
We're seeing blockchain proofs admitted as evidence in court now. The China Internet Court was a big example.
This is critical for managing trade secrets. The immutable record helps a business document evidence of creation and, maybe more importantly, evidence of secure sharing.
So if you share a design under an NDA,
you record that agreement on the chain. That helps you satisfy the legal requirement to show you took reasonable measures of protection. If a leak happens, you have a cryptographic, auditable timeline.
This all brings us to a really crucial point of confusion I see everywhere, which is the tension between ownership and identity, especially when we talk about NFTs.
The distinction is paramount. NFTs are excellent at modeling one thing: ownership. Ownership of a unique asset, whether it's digital art or a token for a fraction of a house.
That immutable record of transactions is what creates digital scarcity and provable ownership.
Exactly. But a lot of people make the mistake of assuming that if they own a unique token, that token is their identity, like a digital passport.
And why is that model just not sufficient for a digital identity system?
Because identity is fundamentally different from owning an asset. Identity can't just rely on a public immutable record. It has to be asserted or vouched for by a trusted external authority.
The government, your university, whoever.
Right. And furthermore, the very thing that makes NFTs work, that immutability, is a direct liability when you're talking about personal identity.
Because of data privacy rules, like GDPR's right to be forgotten.
Precisely. GDPR says individuals have the right to have their personal data erased. If your identity data is permanently and publicly stored on a decentralized ledger, that compliance becomes impossible.
So public blockchains are just fundamentally incompatible with that kind of regulated digital identity system.
In that form, yes. NFTs are great for modeling what you own. They are insufficient for modeling who you are. The privacy and compliance demands are just too great.
So if they can't be a digital passport, what's the most effective crossover use case for NFTs in the identity space?
Ownership-based access management, it's a great fit. Here, your access to a service, say, exclusive content or game features, depends only on possessing a certain NFT in your digital wallet. Your personal identity is completely irrelevant.
Which means the access rights themselves become tradable commodities.
They do. They're independent of your name or personal details. The right to access is now an asset. If you don't want access to that software anymore, you just sell the NFT that grants it.
That completely changed the dynamic of how we control and transfer rights and permissions online.
Such a radical shift.
Wow. So this deep dive has spanned such a huge range of applications. We've gone from global logistics and securing democracy in Estonia.
To automating legal agreements with smart contracts and protecting patient data with private keys.
Right, and redefining digital ownership through fractional real estate, and now clarifying that really subtle but critical difference between owning an asset and owning your identity.
The common thread through all of it remains security, transparency, and efficiency. They're all geared toward fixing weaknesses in these old centralized systems that were built in a pre-internet age.
Blockchain is really just paving the way for a more auditable, efficient, and you could say a more honest way of managing our most valuable assets.
Our goods, our data, and our agreements.
And that efficiency is the real takeaway here. We know the invention of the internet fundamentally changed society because it made the cost of communication negligible. It changed behavior, it changed interaction, it changed global business.
Changed everything.
So if tokenization allows the worldwide exchange of value assets, fractional property, IP rights at a negligibly small cost, what fundamental aspects of society and the economy might change in ways we can't even predict yet? That speed and that low cost of exchange, those are the forces we really need to watch.
Indeed. The potential transformation of global financial and ownership markets, that's just the starting gun for what could be a massive societal restructuring.